Hi everyone, in this video we're going to talk about the risks and how to decrease the level of risks in your investments. And I've been reading the articles on the sites, and I think they're not telling the whole truth about the stock market, and they prefer diversification, but for me, in the practical side, I see like this picture. I like this picture. If you lay awake at night worrying about your investments, they are probably too risky for your investment temperament. And the diversification itself, it helps, but for example, in a simple Wall Street, I found a Tesla, and we can see that there's a lot of risks that the stock price considers, like volatility of the share price. You can buy it one day and the next day it's like -10 or -30% off. I'm not telling the Tesla stock is a bad option, but every stock has a big level of risks. And here we can see that interest payments are not well covering operating cash flow. And also the numbers that we see here, for example, 1-year return, 635% is huge. And the industry itself shows that in 1 year, 250%. And also the compares to market, which is only 20%. And as you can see here, the overvaluation is 305%, and you just might buy it from the current price 489, but I would be very skeptical about in any company valuation. I'd rather buy when the current price is near the fair valuation. You can avoid very much of the risks, because whenever the company you buy, if you buy it overvaluated, over 30% or over 100%, 200% overvaluated, it might come some of the time to the fair valuation. So the stock market is a risky place, and I would not recommend to buy too much overvaluated stock. And also, if the stock is overvaluated, and for example Tesla have good forecasted earnings and so on, but if we look at some company that has poor past performance or poor forecasted earnings growth, or they have a lot of debt, and also if they have the level of the equity minus, that would be a serious situation, because it's more critical than the high level of debt. And also how the company performed, how it's for example earnings per share growth, or is there shares outstanding decreasing or increasing, does the total sales growing, so how it looks. And also a lot of investors and myself recommend to buy the stock, the company, which you pretty much know what they are selling and doing, and that makes you a little bit little bit of warning of what could possibly happen if something goes wrong or they or right. So yeah, those are my and if you invest long term, the price volatility is not so important because you can buy it when the stock price is, for example, 500. Then, for example, if it goes if it goes if it goes if it goes down, you can buy it like on the 400. Then if it goes 300, you can buy there. And in long term, the statistics shows that those investments in long term and also investing periodically, for example, once in a month, decreasing the risks of losing money. Thanks for watching this video. Subscribe to the channel, like the video, and see you in the future one.